I'd like to thank everybody for joining me today. Today, I want to talk about charitable planning. As we're getting into our year-end tax planning, this is a good time to review is charitable planning a good option for our clients? A lot of times with charitable planning, it could be just tax driven, it could be just charity driven, but it's also a time where if we look at our charitable options, it may be a good time to look for our clients. They can plan for their family and take care of their family the way they want and do the charitable giving that would benefit them and benefit the charity. As you start looking at charitable options, one of the big thing is to think about what assets you can give to charity. It can be just cash, can be business interest, it could be securities, it could be retirement accounts, anything that really is an investment asset or liquid assets can be given to charity. So think outside of just cash and see if it can be a better fit. Well, if we want to keep things simple, simple is a direct gift. If we make a direct gift, our clients can transfer property to the charity and they're going to get a tax deduction. That's simple, that's easy. That transfer of property can be cash, it can be real estate, it can be stocks, anything that they want that the charity is willing to accept. And, and they're going to get a tax deduction based off the fair market value of that asset. One of the newer things that we can do is qualified charitable distributions. What I like about qualified charitable distributions, I work with a lot of clients that have IRAs that they just don't need for retirement. Well, if they don't need that for retirement and they take that as additional income, well, that just means additional taxes. But they can distribute that part of that IRA each year to the charity. Now they don't get a charitable deduction, but they can exclude that distribution from their taxes. Now, to do this, it has to be coming from an IRA. There again, if they have a 401k, we can roll it to an IRA and then do the distribution to charity. They have to be at least 70 and a half years old. The max they can do this year is 105,000. And this is the part I like. It can count towards the required minimum distributions. So if if there's excess income being generated by the IRA that our clients don't need, this could be a good option to benefit the charity and again, reduce the income taxes for our client. Now, I also look at, let's take the next step in the charitable planning world. Can we leverage the assets? Can we make sure we're taking care of our client, taking care of their family, and also give more to charity? To do this, I look at repositioning assets using life insurance. So let's say we have assets that we don't need, are underperforming, whether that's CDs and savings accounts, investment accounts, whatever that is, we can move that into the life insurance policy. Typically, that can either be premiums each year. We can use a single premium immediate annuity or a premium deposit account to spread that out over time and create that life insurance policy that benefits our client and is designed for our client. Typically, these policies are cash value policies. And I like the cash value policy to create the what if benefit for our clients while they're alive. So while they're alive, they can use that cash value tax free if the policy is designed correctly for whatever they want. They can use that to, cover needs for the business, cover their long-term care expenses, take a trip around the world, make gifts to their kids and grandkids. Whatever it is during their lifetime, they have tax-free access to that cash value for whatever needs arise. And there's a lot of things that come up for our clients that we just can't plan for because it's what if it happens? And this creates that nice what if bucket. Now, the death benefit is where we can leverage both to the heirs and to charity. Let's assume that we have a $500,000 CD that we want to move into this. Well, if that $500,000 CD were to create $1 million of death benefit, well, we can still move 500,000 to the heirs just like our clients want. and they can benefit the charity that they like and that's doing good and give another 500,000 to them. There again, it's a leverage of their assets. But during life, if we want that what if cash value, we can create that into this as well. All of that, if done right, can be income tax free. And if we need it, can be estate tax free as well. Now, let's take another step in the charitable giving world. Charitable giving plus. And with this charitable giving plus, it's more than just giving it to the charity. It's also taking care of our clients for their needs going forward or their needs in retirement. We can use a charitable remainder trust. The nice part about a charitable remainder trust, we can transfer appreciated property. So think about rental real estate that they've done 1031s on. They've transferred basis, have a very low basis. So if they were to sell that, they would have a significant tax gain. Well, they can transfer that property into the charitable remainder trust and create a charitable deduction that they can use on their tax return now. And they have up to 6 tax returns to use up that charitable deduction. When the property's inside of the charitable remainder trust, they can reposition that asset, basically sell that rental real estate tax-free, reposition it into an investment account, annuities, whatever they want. And with the money that's now in the trust, they can create an income payment back to them for their lifetime, for their joint lifetime, for a set number of years. But they're going to decide up front how much of a percentage do they want to take out each year. So think about if they put $1 million into this trust and they take out a 5% payment each year. Well, that's 50,000 a year that's going to pay out. Hopefully, and the way most of them are set up for the joint lives of our clients if they're married spouses. At the end of the trust term, so at the end of our client's lifetime, whatever's left in the trust can distribute to charity. But there again, the charity doesn't get anything until our clients have passed away, have used up the money that they wanted to distribute from the trust. Now the charity gets benefited just like our client would like it to happen. Now, we also have what's called a charitable lead trust. And with a charitable lead trust, what I like about this is we can create tax deductions now, we can create benefit to the charity now, and that money will come back to our clients or their heirs to be able to be used for retirement, for whatever in the future. Here again, when we transfer that property, think about rental real estate, think about an investment account. Whatever it is, we transfer that from our client into the charitable lead trust. The day we do that, we create that charitable deduction. Again, 6 tax returns to use up that charitable deduction so that we make sure that's a benefit for our client. All of those, whatever that asset is, can be reinvested inside the trust. This happens a little bit different. But a charitable remainder trust, we can make that sell the property inside the trust and do that tax-free. We don't have that tax-free sell inside of a charitable lead trust, but with a charitable lead trust, we can put cash in there, whatever assets we want. And typically this can be done, late in the year for tax planning purposes, create that charitable deduction. Now, here's the benefit. We're going to create an annuity stream, an income stream to that charity for a set number of years. So maybe 5% every year for 10 years. So if we put $1 million in the trust, we're going to distribute 50,000 a year to the charity for 10 years or 7 years or 15 years, whatever our clients decide they want that to be. The more they pay out to charity, the bigger their charitable deduction is going to be. But at the end of that payment term, whatever's left in the trust comes back to our client or to our client's family. So the way I like to look at this, if you think about a charitable remainder trust, keep in your mind a charitable pension. That's going to be a pension that you can use for the rest of your joint lives. For a charitable lead trust, think about this as a charitable retirement plan. We're going to get a charitable tax deduction. We're going to have that stream of income going to the annuity for a set number of years. And at the end of that term, it comes back to the family to use for whatever they need in the future. So charitable planning can be a great tool. It doesn't have to be all or nothing. It doesn't have to be the family or the charity. It can be a win for their client, a win for their family, and a win for charity. If you have questions, feel free to reach out. And if not, we'll talk again next week. Thank you.